Hello everyone and welcome to another video of phase 4. So in this video I want to talk about having a trade plan and a trade model. Now the thing is, they aren't the same and they're two different things, okay? And I want you guys to be able to differentiate the two and have an actual trading plan and have a trading model. Because without this you won't have any form of consistency, because you won't be able to be accountable for your losses, for example, or your mistakes that you're making in trading. Because say if you have a plan and you know this plan works, and say if you have a model and you know that model works, and then suddenly you stray from it, you know why you lost, you know why you're not performing as well. Without having this, you're basically running into the market like a free-for-all basically, because you don't really have a set plan of what you're going to do. So having a trading plan, what does that mean? So having a trading plan is essentially what times you're going to trade, so that is basically your sessions. So whether it's London, New York, or Asia, right? This is quite specific because some of you guys will start trading random hours, and the thing is, if you're trading around the sessions, especially when the sessions are open, that's when you get the most liquidity and the most volatile movements. And bear in mind, that's what our strategy is based around. You can sort of work out your hours around this, because the key is you don't want to be sitting in front of the charts for too long, because you do have something called analysis paralysis. It's completely normal. If you're staring at a chart for so long, you're going to completely forget what you're looking for. And you need to have a healthy balance of screen time and screen off time. And without that, if it's not healthy to spend so much time on the charts. Obviously, when you're learning, you want to have as much chart time as you can, but then you need to understand that there is somewhat of an optimal flow of how you work and how productive you are. Doesn't matter how many hours you put in, doesn't matter how many times you watch the course or how many times you practice. It doesn't matter if you're not at your optimal performance. It's not really going to make a difference to you. Okay, so having a set time of when you're going to trade is the first thing, and this may limit a lot of your trades. For example, if you're taking trades like between New York and Asia, where New York is sort of dying out and Asia is just coming, it's pretty dead around that time, pretty sideways, and say you're looking for trades and you're getting break even a lot and so on, as long as you can work around that, and say for example you don't perform best then, don't trade then. So developing your trade plan, I can't give you a plan, okay? You need to develop your own plan. If I could give you a plan, I mean I would, but it's very individual to how people respond to their plans, especially with the fact that of time difference and so on, and your lifestyle, whether you've got a job that you need to do and so on. It's a little bit different, so it doesn't work with everyone. It's not a one size fits all thing. So what I would suggest is identifying what times you perform best, and this comes from your journaling. So in your journal, you should be writing when the session of the trade was, and then you can see when you perform the best and when you perform the worst, and then you know to avoid that. And the thing is, it's all good making a plan, but if you can't stick to it, there's no point having one. So the whole point of having a plan is that you need to stick to this plan. You need to stick to the hours that you can trade. To be fair, sometimes I do stray from my plan, but most of the time I'm following it. And I want you guys to make sure that you have a set time of when you're going to look at the charts, when you're going to prepare, when you're going to analyze, and when you're going to actually start looking for entries. Okay, it's a very key thing. Another thing you want to have in your trade plan is your risk management. Now, risk management is something that, again, it is very unique to you. So in terms of risk management, you want to understand, you want to have a set percentage risk that you want to use, and that is completely up to you. I wouldn't suggest using anything above 2%. Even 2% sometimes is quite big. I mean, I use 2% when my account is a little bit smaller. and as the account grew, especially last year, as the account grew. So I started off with 2%. As the account grew, I went down to 0.25%. Because the thing is, as your account gets bigger, you don't need to risk a lot to gain monetary wise. However, in terms of percentage wise, it may not look as good. But to be honest, it doesn't matter how it looks, because you're trading to make a return, you're trading to make capital, and you're trading to make a living, right? And that's the main thing. It's not about what other people think, and it's not what other people are using. Now, with risk management, it does come into the fact risk management can play with your psychology a little bit. Well, not a little bit, a lot. Because if you're risking too much, it may result in you, say for example, you take a few losses. If those losses are affecting you so much, you are risking far too much on that trade. It's okay, it's not a problem. Just reduce the risk until you feel comfortable executing. Okay, because a lot of the time it is the percentage risk that you are using that will limit you from entering trades if you have like a losing spell, for example. And the thing is, these losing spells, it will happen, but as long as that you're aware of it, and as long as you acknowledge that you will lose along the way, it's all good. But you need to make sure that you have that idea of what percentage you wish to risk. Okay, and this also comes into having a plan for losses. So you need to be fairly strict on this, I suppose, purely because, for example, if you've taken like 2 or 3 losses in a day, you need to understand when do you stop, right? Now, it's up to you how much of an account you prepare to risk per day. That's probably the best way to see it. Then you can work out how many trades you want to take, or how many trades you're allowed to take following your plan before you need to stop. For me, I don't do it per buy percentage, I do it per trade. So if I take 3 losses, I generally stop for the day. That's enough for me, whether I'm using 2%, 1%, or 0.25%. 3 losses, I think for me the loss is detrimental enough for me to stop. So that's why I stop, and I'm very strict with that. So what I suggest doing is either having a percentage risk for the day, or having a set number of trades that, when you lose that, then you're done. Okay, you don't want to carry on. You need to be strict with this. You can't, even if you see an opportunity that follows your trading model, it doesn't matter. Okay, because you still need to stick to your plan. It's okay. You need to understand that there will be trading opportunities almost every single day. Not even almost, there will be trading opportunities every single day. You could come back the next day with a fresh mind. Okay, now with a trade plan, it's a little bit different. So you need to also understand what type of trader you wish to be, whether you want to intraday, whether you wish to swing, or whether you wish to scalp. And this is when we're going to start talking about the trading model. Now, understanding what type of trader you wish to be will help influence what you do for your trading model. Now, in terms of your trading model, so for example, if you wish to swing, and that is what we majority of the time do at Vertex, myself and James, this is following your higher time frame intentions, right? So it's a higher time frame rules by entering, obviously using our entry criteria on a lower time frame. Okay, so this for us is our 4 hour and above. That is our swing potential. That is our swing ideas. However, if you're going for intraday or scalp, you need to understand the difference. So these two, so I'm going to write them in the middle of both them two. So both of these two, these are all your lower time frame plays, and they last between a few hours to a day. Okay, also. Now, the difference between here, your swing potential, your swings are essentially your big higher time frame move. Now, if you're coming into the market with a swing potential, and say for example you don't see any swing ideas, and you think, okay, I'm going to intraday for a little bit. If you are going to do that, you need to make sure that you have a model that allows you to do that. Because, for example, your swings are essentially your big higher time frame plays like this. Okay, that's your swing, and say that's your 4 hour. Your intraday and your scalps will be trades that are along here, and here, and here, and so on, right? You need to understand what your higher time frame narrative actually is. So say, for example, if the overall higher time frame is bearish, you need to be aware that even if you're buying up to here, you need to be aware that your higher time frame POIs are here, right? Now, the reason why I'm mentioning this is because this can be confusing for a lot of you, and I've seen it as well, where you can't switch between the two. You need to be able to identify whether you're scalping or whether you're swinging. Because if you're scalping, remember, you are following range after range after range, right, throughout. Your targets is the main thing. Your targets are going to be smaller. You can't have like a scalp trade here, right, with your target all the way up here because your higher time frame is bearish, right? You can't do that. And it's very easy for that to happen. However, you just need to be able to identify what you're going to do. Now, to do that, okay, what you need to have, let me get rid of this. So to do that, you need to be able to, so for your swings, you need to be able to understand how you're going to enter the trade. So say for your swings, you want to follow your 4-hour entry point 1 or entry point 2, for example, and then you need to have a model of how you're going to enter that. Okay, and you need to have a plan whether you are going, you need to have a plan whether you prefer going pro trend or counter trend. The problem is, if you go in counter trend, you need to understand that your counter trend is lower probability. So it's up to you in terms of probability sake and what type of risk appetite you have, and what you're happy to trade with, right? So for example, if you're going for your pro trend move on your high time frame swings, you know where your targets are, and your targets are fully based on your higher time frame, and you're following the order flow of the higher time frame as well, and you're following the rules. If you are intraday or scalping, so this is where it comes a little bit difficult, not difficult, a little bit interesting, because although you have this higher time frame play, you are looking for order flow and mitigation play and your rules on that lower time frame to play up or down, considering. Now, if you are going to scalp, right, say if you catch a scalp entry here, your overall bias is bearish, you know you can hold this for a longer period of time purely because you know the potential is to go further down, for example, to this first low, okay? If you're scalping from here, for example, you know that you cannot hold this for a full swing. This is where a lot of you struggle. You need to be aware of what your higher time frame is doing. It's all well and good following the scalp model, for example, or following an intraday model, but you need to understand that what your higher time frame narrative is what matters. Now, another thing to include in your trading plan, your trading model, is how you're going to actually enter the trade. So whether you're going to do risk entries, so risk entries is pretty much, let me put that here. So you're going to talk about your entries. So in terms of risk entries, it's very, very easy. Obviously, you know you're going to do a risk entry, but if you're following confirmation entries, you need to understand whether you're going to do your whether you're going to wait for your order flow and whether you're going to enter on entry point 2 or entry point 1. You also need to have a plan of whether you're going to do an inception here or inception there. Okay, you need to be aware of what you're going to do, because this trading model allows you to have a rule-based approach. Because say, for example, so how to develop this, it says, I want you to practice all of them and find which works for you best, and that's for your journaling, and then focus on that one specific model. So say, for example, you perform best at looking at order flow confirmation and entering at entry point 2 with an inception entry. Okay, say that's where you perform best. That's all you want to focus on. You don't worry about anything else. If your model isn't there, you will not enter the trade. Okay, that's what I'm trying to get across. If your model and plan is not there, you will not enter the trade. And that's what having a rule-based approach is. So you need to identify how you trade best. Okay, I cannot give you this because it's very individual and it depends on your risk and how cautious you wish to be. So essentially what I want you to have is identify your trade plan, identify what times you can trade, identify your risk management, what risk you want to use, have a plan for your losses, and decide whether you want to intraday, swing, or scalp. And when you do that, have a model for each one of them, because if you're going to decide, and to be fair, a lot of you will decide to do all three of them. If you are going to do that, have a model for each three. So say, for example, you're going to do your swing one, you'll only enter our 4-hour POI, okay, but using entry point 1, for example, or entry point 2, okay, or using entry point 1 with inception. It's completely up to you how you wish to do that. It's completely different to everyone, and this is where, although we're following the same strategy, this is where you as traders will differ in the group, okay? So what I want you to do is, this video is incredibly important, and it's probably one of the most important videos to pay attention to. So what I want you to go away and do is develop a trading model, develop a trading plan, and stick to it. If you don't stick to it, then I can't really do anything more than that, apart from remind you of it. But the whole idea of having a trade plan is to aid your consistency, and without it and without following it, you will struggle. So I hope you guys have enjoyed this video. I hope it was insightful, and I hope this helps you develop your trading model and plan.